This is Bazaar Morning Call, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. And it's a full house today. After some time, I'm Prashant. With me, my colleagues, Sonia and Nigel. And what should we start with, guys? It's raining cats and dogs outside. Last night was terrific with that tennis match. So I guess all of us are going to be a bit groggy.
And the markets are at all-time highs.
And the markets are doing well.
Well, what a game last night, right? I mean, it had class all over it. That 20-year-old coming in there.
Yeah.
You know, at crucial points, hitting a drop shot, you know, going for the outstretched winner on the forehand. It was absolutely brilliant tennis. I haven't seen tennis like this in a very, very long while. And the crowd was backing the youngster.
Absolutely. 20-year-old, right? And
yeah.
I think men's tennis was lacking a prodigy for a while. I mean, Djokovic, Federer had tennis in a chokehold for very, very long. And now finally someone who's perhaps, termed as the real deal. But it was epic. Really.
I'll tell you a small incident. My kids actually say a small prayer before going to sleep. And and they'd already said yesterday's prayers. And before the match started, and I went into the the bedroom with the TVs, and my son was saying a prayer, and I said, "Well, what's going on? I mean, you just said your prayers." He said, "Well, I want Djokovic to win." So it was a little.
It was the end of an era, so to speak, or the start of a new one, rather.
But 36 years old, and what a game, right? 4 hours plus. I mean, you got to say something about the guy. But let's see if this is really the passing of an era. If this is just one sort of Grand Slam, and there are many more to come. Djokovic has won the French Open, he's won the Australian Open as well, just this year, right? So we'll see, but this is a big one.
I don't know if you guys remember, but when you were younger, there was this, Michael Jordan, right, in basketball, and there was before him, Magic Johnson was the GOAT of basketball. I used to watch a lot because of my brother. And when Magic Johnson sort of passed the baton to Michael Jordan, it seems like that. There's like a power shift, happening right before your eyes. So pretty epic, if you don't call it.
It is absolutely. Well, let's kick it off in terms of what you need to know as far as today's trading session is concerned. And it's looking good. I mean, let me just begin by saying that. And I'll tell you why. Because last 1 week, we've seen what I would call it a bit of a regime change. A new narrative is really taking hold in markets over the last 5 or 6 days. And I'll explain. The new narrative is that the soft landing, which is basically the ideal choice for the Fed, which is not too hot, not too cold, that is becoming the base case for many now. When I say soft landing, I mean soft landing for the US economy. What is soft landing? It is basically a combination of softer inflation and at the same time, a labor market which is not weakening too much. So it's like a Goldilocks kind of a situation. Inflation under control, but no dearth of jobs as well, good jobs as well. And that's where the US seems to find itself. This is the data which backs it up, right? So CPI on an annualized basis came in at 1.9%. The Fed target is 2%. So it's right under that 2% threshold. And job growth in the US is still pretty strong at almost 210,000. These are, the last stated numbers that we had. So just putting this together. And look at how the markets reacted. The 2-year has seen an absolute crack. 40 basis point fall in 6 sessions flat. From a high of 5.1%, intraday high of 5.1% on the 6th of July, it closed at 4.7% on Friday. By the way, the Friday bond yields went up a little bit. But even accounting for that 2.5% move higher, it's a 40 basis point fall in just 6 sessions flat. The dollar index, right, it's even more dramatic. The dollar index is down 4% plus in the last 6 sessions. From a high of 103.57, it's fallen to 99.91 on Friday. These are dramatic kind of falls that we're talking about, especially for the dollar. And, the dollar bears are out in full flow with arms saying, well, the decline of the dollar is here. It's going to be long lasting, etc., etc. We've heard that story before, but this decline, I think, bears watching. Now, the backdrop, this is disinflation, right? Dollar weakening, yields coming off. These are market rates which portend disinflation in the US, which is positive for emerging markets through various channels. The easiest way is through the forex and the rates route. For emerging markets like India, it's positive for the currency here. It's positive for bond yields as well. It takes the pressure off, headwind off for emerging market rates and forex. Now, in India, we saw a good pullback on Friday. Last week was, except Friday session, it was largely sideways. But we saw a good pullback on Friday, backed by pretty solid flows from FIs as well, which we will talk about more in a bit. So in that context, in the context of the pullback that we had on Friday, these are the levels. For the Nifty, the upside level is basically the upper Bollinger Band, which comes in at 19,740, approximately, roughly 19,740. On the way down, Thursday's low is something that I would say you need to watch. Should not be broken, which stands at 19,386. We left off at 19,564. So that's the Nifty. Bank Nifty is interesting. It, by the way, got to within 80-90 points of the 20-day moving average, and then it kind of bounced. It reversed higher. It reversed strongly higher after being lower, like the Nifty, for the bulk of the prior week. On the way up, the Bank Nifty's earlier high comes into focus. If a bit of a consolidation phase in an uptrend is behind us with Friday's move, we'll see. But the levels which will confirm are these. On the upside, the higher levels are 45,655, and on the way down, the Bank Nifty, if there is selling pressure which emerges, needs to defend Friday's low of 44,547. We left off at 44,819. The Gift Nifty will come up on your screen, which should give you an indication. I think bulk of Asia is not doing very well, and we'll kind of pick up there. But I think the broader kind of backdrop in the US from a global perspective, notwithstanding the strong rally that we've had, still looks pretty constructive. Sonia.
Oh, absolutely. And, last week, the momentum was intact. And even IT came back in such a big way last week, despite lackluster numbers from a lot of the large cap names, right? So now there are many leaders in this market, including some of the laggards like IT. That speaks a lot about how much momentum this market has. There was large foreign investor buying yet again on Friday, and that's 2 days of over 2,000 crores of buying in a single day. So on Friday, there was about 2,600 crores. On Thursday, there was 2,200 crores. So definitely money coming in thick and fast from foreign investors. Now, this is a big week of earnings. We start off with HDFC Bank today. We end the week with ICICI Bank on Saturday. There's Reliance Industries on Friday. And just look at that list. A lot of nifty components coming out with numbers this week. So it could be a crucial make or break week for the market. Let's not forget the Nifty is now less than 400 points away from the 20,000 psychological mark. So will we hit that this week? Could we hit that this week? Time will tell, but these numbers are instrumental to perhaps taking the market there. Global cues remain positive, as Prashant was also pointing out. It was 100 points in the green for the Dow. On a weekly basis, in fact, the Dow notched its best performance since March. It was almost a 2.5% rise. So there's no stopping the global markets there. In that context, earnings have been quite good, actually. So United Health, JP Morgan Chase all came out with good numbers. In fact, United Health raised the lower end of its full year adjusted earnings guidance as well. So there's a lot of optimism over there. And slow and steady, but gold prices have also been inching to a new high. So it's a 3-month high on gold prices after inflation cooled off. So all in all, there seems to be no complaints in the market. It's sort of like a purple patch. But let's see, the run-up has also been fairly steep. Maybe some consolidation is what the Gift Nifty implies. But the momentum definitely is intact.
Well, that's right, Sonia. And we have got such positive global cues. So the global setup is good, which is good news for our market as well. I remember getting into Friday's, closing bell. We were tracking the Chandrayaan-3 and everyone was cheering for that. Suddenly, the Nifty as well had a bit of a rub-off impact. If you look at the intraday chart of the Nifty, from around 230 odd, well, the Nifty took off. It just didn't take off the 19,500 odd mark on a closing basis after 5 straight attempts. It almost hit 19,600 in Friday's trading session towards the final minutes or so. The averaging is what it brought it down to around 19,565 odd. The Nifty Bank, well, that was a bit of a sore thumb just in Friday's trading session. It was trading actually in the red, and in the last hour of trade, it did spike up. There was a bit of short covering that we saw on the Nifty Bank, and the Nifty IT index, in just 2 sessions, it's added market capitalization of more than 1.6 lakh crore odd. So positioning, the negative positioning or the cautious positioning on some of those IT stocks, that's what took them higher. Now, in terms of trade setup, well, the flows, they are taking the front seat because the flows have been very strong. Fundamentals are a bit of a back seat as of now because there are a couple of cautious indicators, whether you're looking at the earnings yield or you're looking at the earnings yield split between the broader markets as well as the Nifty, but that's taking a back seat because flows are so strong. And the Nifty has a date with 20,000 odd. The screen is telling you that. 2 big factors to track. This week, you have the banking stocks, HDFC Bank today, IndusInd Bank tomorrow. And then towards the end of the week, you have ICICI Bank as well as Kotak Mahindra Bank. So the Nifty Bank will be in focus on the back of results as well as Reliance Industries. Results, one factor. Second factor is next week, the Fed will be delivering their verdict. So those are the two key triggers that you need to track as the Nifty makes its way towards the 20,000 odd mark. In Friday's trading session, 19,400, 19,450, 19,500 put. All of them were very, very active, and that's why the PCR moved up. Just two cautious triggers that I'll tell you to track. One is the FI net long position. We have seen when it goes above that 1 lakh contracts odd, that's when you get a little bit cautious. For the time being, it's less than 19,000 contracts. The PCR as well, it's moving towards the upper end of the range, but it's at around 1.34 odd. We have seen when it goes past than 1.5, more towards 1.6, that's when we see some bit of a pullback. So those are the two cautious triggers, but we're still some distance away from there. You need to stay long in this market. That's been the call. The screen is telling you that. 20 DMA, that's very, very deep. But in the near term, going by the writing, we have seen at lower level puts, 19,450, 19,500. Stay long. Keep that as a support zone. GIFT Nifty suggesting a bit of a positive start, guys.
Okay, GIFT Nifty suggesting a positive start. Let's see if that rocket that was launched on Friday, whether that continues to reach new highs this week. On the equities front, though, first up, we have some commentary coming in from Chetan Seth of Nomura. He says they remain tactically positive on Asian stocks, given supportive themes of AI, tech cycle recovery prospects, a still resilient U.S. economy where disinflation continues to gain traction, and China's stimulus recovery expectations, which should provide some support for China stocks. On top of this, he thinks a likely softer U.S. dollar on the back of a likely approaching end of the Fed's hiking cycle should further aid Asian equities.
Okay, well, let's get you some money market views now. B. Prasanna of ICICI Bank says that last week, a softer than expected core CPI in the US triggered a broad-based dollar sell-off. Rupee, however, underperformed as the RBI and oil companies likely purchased dollars aggressively around the 82 levels. He says the benign outlook for the dollar and favorable capital inflows will support the rupee in the near term. Moderation of exports, rising crude prices and likely RBI propensity to add to reserves shall restrict any sharp appreciation. He expects the dollar INR to trade in a range of between 81.75 to 82.5 to a dollar with an appreciation bias.
All right, and on the bonds, V. Prasanna says global yields led by U.S. Treasuries moved sharply lower on soft inflation prints and softer employment data. He says Indian bonds followed suit, aided by comfortable liquidity scenario, which resulted in bull steepening of the curve. He expects the markets to consolidate with the 10-year benchmark bond yield likely to trade within a range of 7.05 to 7.15% range and would await for cues from the upcoming Fed policy.
Well, we have a lot of stock-specific action to track for you. We'll get to that in just a bit from now. But for the time being, let's run you through all the stocks we're tracking in our top 10 segment. We're looking at Just Dial, Unichem Laboratories, KSRAM Industries. They're on the back of positive news flow. On the flip side, you have Avenue Supermarts, JSW Energy, Bandhan Bank, ONGC, Metropolis, Angel One, and Varroc Engineering. They are stocks that could be reacting to negative news flow over the weekend.
Okay, Mark Matthews of Bank Julius Baer and Company is now joining us for some chit-chat on markets. Mark, great to have you with us here on CNBC-TV18 as always. Appreciate your time. Pretty dramatic kind of price action, Mark, over the last 5-6 days, especially US yields retracing big time. 2 years down 40 basis point, and the dollar is down almost 4.5% in that same period. As I was saying, many are now kind of coming around to the fact that maybe the US will skirt a recession and it'll be a soft landing. What does it mean for equities in general, Mark?
It's a positive, of course, and the market is always looking forward. And so it has factored some of this in for sure, because now it's thinking about what is December, what is January going to look like. But the good news is I think that things will be good then too. And the earnings, which we've just entered, of course, the results season, will be their worst in the second quarter, and they'll improve after that. And the language coming out of the companies that report their results will be closely watched, of course. But my sense is that, and the 5% of S&P companies that have reported so far are far too small a number to gauge. But my sense is that companies will be more optimistic on the economy than analysts had anticipated. And therefore, we can continue to rise. I think that the remainder of this year will close on the 31st of December higher than where we are now.
Oh, okay. Are you talking about higher than where we are now just for the US markets, or do you think that could be the case for the Indian markets as well? Because it's already been an 8% rally since the start of the year for the Nifty. Do you see more upsides?
Yes, I do. And in fact, this positive momentum is something which was very concentrated in a small handful of companies up until the end of May. But since then, we've seen a broadening out of it. I should say, not just in the United States, but of course around the world. You've seen emerging markets, as you rightly point out, India start to participate in a rising market, which it wasn't really doing in the first half of the year. So I'll just give you one statistic pertaining to the S&P 500 index, which is that back in March, only 16% of the 500 companies in that index were trading above their 50-day moving averages. And as of Friday, that number had risen to 82%. And if you look back in history at when 80 to 85% of S&P companies were above their 50-day moving average, the returns 12 months forward were higher on average by 85%. And on average, the S&P rose 12% over the 12 months that followed those kind of periods that are similar to where we're in today.
Mm-hmm. Hi, Mark. Good morning. What about the Chinese markets? You know, there's talk that a big stimulus is coming, and going by the data points, maybe that's required because data coming out of there continues to not look very, very great. Your view on the Chinese market from here on?
Yes, there's a critical meeting coming up at the end of July, which is their Communist Party Politburo meeting. There's always the risk in a command economy like China that you can see them suddenly put the pedal to the metal and announce a very large stimulus. But there's no indications that we can gauge that show that will be forthcoming. So they are tweaking things at the margins. But the main problem, I think, is that they're trying to get banks to lend more. And credit officers are reluctant to do that because they're worried that in the future, they might be held responsible for having approved loans that turned sour. And so I don't see meaningful stimulus. I see tweaking, as I said, at the margin here and there, but I don't think there's a big one coming.
I think we've got the GDP numbers for the quarter out of China just now, and I think there's a slight miss, but maybe the market would have liked a bigger miss, right? Because that will get at least hopes higher for a bigger stimulus. And I mean, this is neither here nor there in that sense. Mark, in terms of risks really going ahead, as you said, the market is looking out, right? I mean, a few months out at least. What could it be, in your opinion?
Well, I think the risk is that we're all assuming inflation will continue to trend down. And if the Cleveland Federal Reserve does what they call a inflation nowcast, they aggregate 10 high-frequency data to tell us what the current month's inflation will be. And they're looking for 3.4% headline CPI for July, which, of course, is higher than the 3% we saw in June. Likewise, even if you assume month-on-month inflation is zero, which I think is unlikely. I think it will be higher than that between now and the remainder of this year. You're not going to get headline CPI at 2%. The lowest it'll get to, if you assume that sequential inflation trundles along at zero, is 2.4% by October, but then it would lift up to about 2.8% by January next year. So I guess the concern is that what if inflation just sort of sticks at about 3%. And will that be enough for the Fed, who say that they are intent on getting to that target that they established back in 2012 of 2%? That's a problem because I don't think we can get to 2 in this. 2% made sense in 2012. It doesn't make sense today. There's too much that's changed.
Okay, all right. Well, Mark, we don't have too much time left, but thank you so much for joining us and speaking to CNBC-TV18 as always. Appreciate your thoughts. Have a great week ahead, and thanks for being with us on the channel. Well, that's Mark Matthews of Bank Julius Baer saying that the equity momentum is intact across most global markets and in our own markets as well. Let's take a short break. On the other side of the break, many stocks will be reacting to news flow. Avenue Supermarts will be top of mind, post muted set of numbers. More on that coming up in a bit. Welcome back to Bazaar Morning Call. Hope you're having a good morning so far. The GIFT Nifty is indicating that the start will be quiet, but we don't mind that. It was a big run-up that the market saw last week, so perhaps some consolidation could be on the cards today, but the momentum is still intact. Avenue Supermarts, however, reported a muted set of numbers. Mangalam is joining in. Mangalam, once again, the margins continue to be under pressure?
The margins continue to be under pressure for DMart, but what's changed from last quarter to this one is the slightly positive management commentary. So let's take these numbers, one by one. In terms of revenues, it was an 18% growth, not too far away from what the street was anticipating, and the company had guided for as well on a standalone basis. 11,865 crores on the top line that the company's posted. But it's the operational performance. Gross margins compressed by about 110 basis points. The EBITDA margins compressed by about 130 basis points year on year. And as a result of which, both the EBITDA and the net profit were below street's expectations and below the expectations of a CNBC-TV18 poll as well. Gross margins at 15.2% compared with 16.3%. The street was working with a number well upwards of 15.5% itself. But now here's where the management commentary change has come about. The first part is that they've said gross margins are lower due to lower contribution coming in from apparel and general merchandise, and this is what we've seen over the last many quarters. However, this time around, the management said that this is improving and trending towards pre-pandemic levels. Remember, pre-pandemic, this was around 27, 28 odd percent, but currently had fallen all the way down to 23%. So let's see how soon it can recover. The other positive was that DMart Ready, the online business, has seen a bit of a ramp up in its quarterly run rate at around 281 crores. So the stock will open in the red, but let's see if there is some demand at lower levels for DMart.
Okay, all right, Mangalam, thanks a lot for that. So that's a bit of a miss in terms of numbers. But Rima joins us to tell us about Just Dial. Rima, those numbers look very good.
Yes, it's a good quarter for Just Dial. Revenues have improved on a quarter-on-quarter basis by 6%. On a year-on-year basis, the company's revenues have been above 30% for the fourth consecutive quarter. And even an indicator of forward revenue, that's deferred revenues, has gone up pretty smartly. Margins have been improving up due to operating leverage, which means better revenue growth. So margins are at a 9-quarter high. They're up 50 basis points quarter on quarter and up more than 10% on a year-on-year basis at 14.9%. The cash on the books has always been the support for Just Dial at more than 4,000 crore rupees at 60% of its market capitalization. The only negative in the numbers is their active paid campaigns. What they sign on as customers who are paid customers, that in the current quarter was slightly lower than the run rate in the prior 2 quarters. But stripped of that, these numbers are looking good. Back to you.
All right, and in fact, we will be joined by Abhishek Bansal, who's the CFO of Just Dial. That happens at 10 a.m. today, so do stay tuned in. We will discuss more about the Q1 performance. But let's get down to the granular details on JSW Energy and how those numbers looked. Vivek is here with more. Vivek, morning.
Well, good morning. JSW Energy, a slightly mixed quarter, muted in terms of top-line growth, especially. Now, what's actually happened is that, multiple factors have gone ahead and offset each other. So the incremental revenue that is coming from Mitra as well as the renewable capacity addition has aided the top line. However, lower coal prices has actually gone ahead and ensured that realizations are low, thereby impacting the top line. So top line on a year-on-year basis fell almost 3.5% lower. EBITDA, however, was up 19.5% on a year-on-year basis on increased contribution from the renewable assets, especially Mitra. Our margins coming in at 41.7% versus 34% on a year-on-year basis. However, when you're talking about the interest cost this time around, multiple one-off effects, but the interest cost for this particular quarter was 486 crore versus just around 193 crore on a year-on-year basis. This was on the back of the Mitra interest cost that saw that the company had to do the acquisition. And lastly, on the back of higher interest costs, profitability was down almost 48.3%. Brokerages at this point of time maintain a sell stance on the back of very high valuation that the company trades at. Elara says that the company trades at almost 29 times FY25 price to earnings and 15.5 times FY25 EB to EBITDA. On the back of that, they maintain a sell stance.
All right, Vivek, thanks very much for that. We'll be, by the way, joined by the management at JSW Energy. Prashant Jain, Joint Managing Director and CEO, will be on the show at 9:30 this morning to discuss the performance in greater detail. Now, Bandhan Bank has also reported numbers, a little underwhelming. Abhishek is here with some numbers to tell you the Bandhan story. Abhishek, morning.
Morning, Prashant. So, stress has risen in the portfolio of Bandhan Bank. Gross NPA ratio has increased to 6.76% versus 4.9% in the previous quarter. Some of the contribution have come in from the recent RBI regulation that the bank has mentioned in their con call as well. Slippages increased to 1,360 crores, which compares to about 1,118 crore in the previous quarter. The EEB book, that is the stress portfolio that they have, that also increased to about 6,200 crore. Versus 5,500 crore in the previous quarter. So it now forms about 6% of the loans versus 5% in the previous quarter. On the positive side, the net interest margin has remained stable at about 7.3%, which is flat on a sequential basis. However, PNL is below our pole, both in terms of NI and PAT as well. And we are seeing some of the brokerages cut their target price on Bandhan Bank like JP Morgan, Nomura, Jefferies and CLSA. Back to you.
Okay, thanks a lot for that, Abhishek. We'll also be joined by Mr. Chandra Shekhar Ghosh, the MD and CEO of Bandhan Bank at 9:40 a.m. He'll be detailing the last quarter's numbers. Well, let's move on then. ONGC is another stock that's in focus. Sonal joins us to tell us exactly why. Morning, Sonal.
Good morning, Nigel. Well, after a break of 2 months, the government has gone ahead. They've increased the windfall tax on crude oil production by 1,600 rupees per ton. This, of course, is versus the nil figure that we had earlier. And this has happened because we've seen crude oil prices inching higher. They were at a 3-month high. Today, they have come in for some profit taking. But this is because of the hike that we've seen. They were up 11% in the last 2 weeks. However, the special additional excise duty on petrol, diesel and ETF continues to be nil. But ONGC will be in focus because on crude oil production, it has been increased now.
Okay, thanks a lot for that. Well, Ekta is also with us to tell us about some of the other earnings that came through. There was Metropolis, Unichem, Kesoram Industries. Ekta, how did it look?
Thanks for that. Well, I'll start with Metropolis, which I expect that stock to be in the red because they've come up with their Q1 FY24 update. They've said that revenue is expected to be marginally negative due to COVID as well as a B2G contract, which is a business to government contract, which was insourced by the government in the previous quarter. Q1 margins seasonally weakest for companies with large market share in the West due to summer holidays. They expect lowest margins in the financial year due to lower revenue growth plus marginal cost increase. Plus, they will be impacted by the insourcing of the B2G contracts. So they are negative in terms of the margin picture for this quarter. Positives for Metropolis: core business revenue growth at 12%, premium wellness segment has grown 23%, gross debt at around 67 crores. So maybe that would negate a little bit of the pain which they have indicated in terms of the margins. Unichem and IPCA, I expect both these stocks to be in the green because Unichem has come out with a good number and IPCA is going to be acquiring Unichem. So revenue up 37% year on year, EBITDA 28 crores versus a loss on a year on year basis. Loss has reduced to around 66.8 lakhs. And Q1Q as well, the margins have improved to 6.6 versus 4.1%, and the loss again has reduced on a Q1Q basis. Remember, there was an exceptional last quarter of around 30 odd crores. Kesoram, expect the stock to be in the green because the net loss is reduced to 32 crores versus a loss of around 61 crores year on year. Revenue is up 12% year on year.
All right, thanks a lot for that. Well, a couple of more stocks in focus, and Surbhi is here with us in the studio to talk about that. There's Angel One, there's Varroc Engineering. Surbhi, take it away.
Thanks so much for that. So for Angel One, the news is that NSE has filed an order against the company, and they say this is they failed to monitor the operations of its authorized persons. They've also issued a monetary penalty of nearly 1.6 crores against the company. They've prohibited from onboarding any new APs for a period of at least 6 months, and also Angel One has to conduct an inspection of all its APs and submit a report to the exchange within the next 6 months. For Varroc Engineering, they have revised the deal with the French company, and now Varroc Engineering will receive 13 million euros in their escrow account versus 28 million euros earlier. Now, just to give you some context on this, in April of 2022, the company had entered into an agreement with the French company to divest its four-wheeler business in the Americas and the Europe region. In October of 2022, the deal price was revised downwards to 520 million euros from 600 earlier, and also the escrow was revised downwards to 28 from 35 earlier. So now it's further reduced to 13 million euros from 28. So expect some red on that.
Thanks a lot for that, Surbhi. Well, let's do a quick recap then of all the top stocks that we just highlighted for you. The ones with positive news flow include Just Style, Unichem and KSRM Industries. While the remaining list, well, they'll be reacting to negative news flow. That includes Avenue Supermarts, JSW Energy, Bandhan Bank, ONGC, Metropolis, Angel One and Varrock Engineering.
Okay, well, we'll take a very quick commercial break here, but Prakash Devan will be with us for some stock talk on the other side of this quick commercial break. Stay with us.
Welcome back. You're tuned into Bazaar Morning Call and hope you're having a good morning. Well, we just ran you through all the stocks that we're tracking for you. So let's get a little bit more specific. We have Prakash Devan who's joining in to help us out with some fundamental analysis on all of them. Hi, Prakash. Good morning. Thanks so much for joining. And I hope you had a good weekend, Prakash. Well, plenty of stocks, plenty of result reactions as well that we got over the weekend. And one number that looked good. Let's start with the good first. You had Just Style. Those numbers look pretty good. Good cash balance as well. Growth is coming about. Margins looking up. Your view on the stock?
Good morning, Nigel. Yes, thanks. Yeah, I did have a lovely weekend. So I think the results over the weekend have been a mixed bag with Just Dial, possibly the only silver lining in this otherwise muted numbers. And what's interesting about the numbers from Just Dial is that they've started seeing operational improvement, and it's not like, one-offs which has led to this, change. And I think the fact that they have still not gone ahead and marched ahead with revenue growth impetus, it's more of, a refining of the margins that's happening. And that refinement process, that entire, debottlenecking in their processes is something which they spoke about some time back. And that's what's resulted into this thing. So they will rationalize, I think you'll continue to rationalize their mix in terms of, client mix and in terms of the services. And they would, if they were to start focusing on that with this kind of, cash on the books, there's lots that can be done. So the optionality goes up if their basic operational metrics are in place. So that's finally happened on this particular quarterly numbers. And I hope that they kind of continue to improve on that, because this is work in progress for sure. But my sense is that people will wait to see this endorsement of this improvement, maybe for one more quarter before they kind of jump in. So it has been low on the institutional appetite. It will only change if some sort of a continuity is indicated from the operational mix. So that's what I would wait for. But yes, it's a great turnaround of sorts in terms of the trajectory of where it was headed.
And something perhaps the street has been recognizing, right? I mean, in the last 3 months, the stock is up 30%. But let's talk about some weak numbers as well. The problem with Avenue Supermarts is that not only is it a second quarter in a row where, margins have been under pressure, management commentary is not great, but despite the valuations getting adjusted downwards a bit, it's still trading at 70 times forward. So do you think that there will be a lot more downgrades coming through on Avenue Supermarts? And what do you do as a long-term investor in this stock now, Prakash?
Good morning, Sonia. So you're right. This has been the darling of the market and the retail segment. It's been the poster child of sorts. But where it's hurting is, the other players, which probably are more unsung heroes, the likes of Zudio and Trent and all of them, they have actually eaten into a significant mind share and now wallet share on the general merchandise and the apparel side. So, if you step into a Zudio outlet, you'll kind of realize the kind of, the propensity for people, the footfall conversion into sales is so high as compared to DMart, where probably the average ticket sales haven't really inched up above the pre-pandemic level. So probably I think their focus is more on broad basing themselves. They've expanded quite a bit. So, you will have this kind of time taken to stabilize. But it is an expensive stock. So, you really, the issue is that if it's so expensive in terms of valuation, so rich, you probably don't want to see any kind of a letdown in numbers, right? So, I mean, it's priced to perfection in that sense. So any letdown will possibly result into some sort of a setback on the expectations of the street. My sense is the margin improvement, if it is the growth outlook is not very positive going forward, there will be some sort of compression that the street will start penciling in, and which means at least about a 10 to 15% kind of a downside from here, which is quite significant for the street. So for long-term investors, it's best to tide over this phase by staying in. It'll probably go through a time correction and a consolidation. Don't get disheartened if you've got it at lower levels. I'm sure there's enough cushion for most investors who have bought in at lower levels, but don't expect a scorching growth from here on as some of the other players have done. You'll have to probably bide your time. That's the only thing that these numbers tell you.
Prakash, hi, good morning. IT services stocks, right? I mean, this week Q1 was so well advertised, and we were talking about it before the earnings season started, that maybe numbers will be bad, but will the markets react? They reacted, but on the upside, because I guess it was well known that Q1 will be weak. But what now, you think? Because last week has been good generally, despite poor numbers.
Good morning, Prashant. So absolutely, I think it's all to do with positioning. We spoke about this last week when a couple of those numbers came through, that the street was probably anticipating the worst kind of a situation where, the recession would hit them hard and, things would not kind of look up or would take too long to start looking up. But the commentary that has come in, the body language of the managements, let's say HCL Tech, I mean, while they had weak numbers, they were absolutely unperturbed about the guidance for the rest of the 3 quarters. So it tells you that probably the bottoming out process is what you are seeing at this point in time. The same thing was with Wipro. I mean, Wipro improved some of their metrics. The expectation was too low, and it started looking so positive. So my sense is that your entire setup will probably start recalibrating itself in terms of what kind of growth to look at. So growth versus time, if you were to evaluate that from a PEG basis, these stocks probably don't look as expensive because growth will come back in the subsequent years or subsequent quarters at least. Now, the worrisome part is that some of these companies probably still don't have what you call, a very high expectation in terms of growth. So any PE expansion will also be restricted. It's not that, suddenly people are buying into it with a 20-30% kind of an upside expectation over the next few quarters. But the fact that all the short sellers have probably had to be kind of, swearing off their positions is what's led to this kind of a bounce. I would believe it will probably consolidate a bit going forward. And the mid-cap companies, the IT companies, Prashant, which probably next week onwards you'll start seeing some numbers come through, will probably do very well. The likes of Cyient, Coforge, Sonata. So that pack of companies is going to probably show you even stronger numbers because they've been more agile, more recession-proof in that sense. And if the US data is turning positive, I think will get its positive headwinds to sail along.
Okay, Prakash, we'll just come back to you in a bit. Actually, we have to also address the other issue that came through, which was the government increasing the windfall tax on crude oil production to 1,600 rupees a ton. Now, remember, this increase in windfall tax comes in after a gap of 2 months. Prabal Sen, the energy analyst at ICICI Securities, joins us now to talk more about that. Prabal, good morning and thanks for waiting by. Will this move the needle at all?
I think the government has been very proactive in terms of changing the windfall tax in line with the way that crude prices have been moving. I mean, if you look at literally from July of 22 through to now, where this $2.7 a barrel roughly windfall tax has been imposed, the net realization for the OMCs has actually remained there or thereabouts between $75 to $76. So while it is obviously, it takes away some of the profits that maybe ONGC and Oil India have been making over the last, couple of months, the fact is that their net realization is still at about the target level that the government had earlier spoken about. And this is still definitely well above the last 7 to 8 year average realizations that they did, barring, FY23. So I would think that while it moves the needle, it doesn't really change. I don't think the street is building in anything more than $73 to $75 in any case. And I think even with this tax, the realizations remain at that level.
Morning, Prabal. What are you factoring in terms of crude oil prices for the remainder of this year? Is there an upside to that level that you're looking at?
For the net realizations for ONGC or Brent levels?
Yeah, Brent levels. And you could also give us ONGC realizations, yeah.
Right. So, as I said, ONGC and oil realizations, we continue to build in somewhere between $73 to $75. We do believe that the Brent level, and it's very unlikely that crude prices themselves would, fall below that level. That's the first assumption. As far as Brent levels are concerned, our sense is that, if you look at the supply situation today and the kind of demand estimates that still are there for CY23, anywhere between 1 million barrels a day to about 2 million barrels a day, depending on who you speak to. The fact is that crude prices should actually rise up a little bit from here. But I also do not expect that there would be a huge rally because, the Chinese demand momentum continues to remain weaker than what people estimate. And, even in the US, there are still significant concerns with respect to when they come back to start building their inventories.
Prabal, hi, good morning. Any thoughts on Reliance from here? I'm sure you're getting a lot of queries, interest around that name. It's done well recently. There is lots of triggers coming up, right? Jio Financial Services, the record date for that. Retail, we've got some idea about valuation, at least how Reliance is valuing that entity. Your thoughts?
No, I think with Reliance, obviously there's a lot of news flow that has been happening, and we're still trying to understand the impact on the Jio Financial Services on the overall valuation. The fact is that, the treasury investments that have been actually transferred were not really been given too much value earlier. So to that extent, that straight away adds an element of, an incremental valuation to the numbers. We are reviewing our estimates, to be honest with you. So I wouldn't want to comment too much on what our SOTP valuations are. But I think with the AGM speech also coming up, with the extinguishing of minority stake in retail and providing a new benchmark pretty much for what the retail segment is to be valued at, and the financial services, I think there's obviously going to continue to remain fair amount of interest in the story over the next 12 months.
Is the value for Jio Financial Services in the ballpark of 150 to 200 rupees a share?
Yeah, if you were to look at the net worth that was published for FY22, as well as the kind of value of the treasury investments, and you put in a holdco discount of anywhere between 20-25%, roughly, yes, around 150 to 160 rupees is the potential addition at this point of time to the SOTPs.
So one last question then. What's the house view on the oil and gas space overall now? And what are the top picks in this sector for the next, say, 12 to 18 months?
We are fairly positive. I think after the kind of year that FY23 was, our sense is that FY24 will be a much stronger year from an earnings perspective. Our sense is that, the OMCs in particular are going to probably lead the way in terms of the kind of change in earnings prospects. As I mentioned earlier, even ONGC and Oil India both have decent amount of production, increase in store alongside realizations, which while down from 23 will still be higher than historical averages. And for gas space also, the kind of changes that the government has done, plus the moderation in spot LNG prices are both positives. So on an overall level, we continue to remain positive, specifically on HPCL and BPCL in the OMC space. ONGC and Oil India both in upstream, and IGL and MGL would probably be the preferred picks in the CGD space. So those 6 names are the top preference at this point of time.
Okay, all right, Prabal, thanks so much for stopping by, giving us your view, wishing you a good day ahead, and give the kids a big hug from our side as well. Time to slip into a short break, but coming up next, Anuj Singhal will be joining to give us straight setup. Post that, we'll bring you the top stock picks for the day from our technical and F&O experts. You stay tuned.
Okay, welcome back. The market pre-open is just 10 minutes out. So let's go across to Anuj, who's in the studios. Who's going to tell us what he's making of the market price action so far. Anuj, good morning.
Morning, Prashant. Good to have you back. You know what? No Monday blues for me because yesterday night, what a game it was. And to have the prodigy becoming the new king, I think that is keeping me this morning very excited. But for the market, I'll begin with the same chart that I showed on Friday. Infosys chart, and the fact that it was ready for a big move, and I mean it was up 4%. Very interesting. Now this is the chart that we are referring to. This downtick that you see is after last quarter's numbers, and this is the gap that Infosys stock was trying to fill for last many days and was unsuccessful. But what happened on Friday, in one shot we moved there, and look at that blue line. That's the 200-day moving average, the only large cap IT stock which is still below the 200-day moving average. And my sense is that in due course perhaps it gets there. Now why is IT rallying? TCS is 1.7% away from 52-week high. Tech Mahindra actually hit 52-week high on Friday. HCL Tech is very close to 52-week high. The market's betting basically on two factors. Yes, this quarter is poor, but this perhaps is the last poor quarter. From here on, things can only improve. That's market's hope. And the bigger reason is what's happening in the US. With the way inflation print has been for last many days, now there's serious talk of interest rate cut. Forget about pause. Interest rate cut, the Fed pivot could be a reality as early as September. And that's why a lot of people believe that valuations will once again increase for IT companies. But that's for the medium term. We'll talk about short term here, and here you have some very important numbers lined up. Starting today, of course, with HDFC Bank, a welcome change from Saturday to a weekday. Infosys, of course, comes out on 20th July, and I hope HDFC Bank's move rubs off on ICICI and Kotak, both of them reporting on Saturday. Together, these four stocks account for 40% of Nifty weight. So, arguably, unarguably actually, it's the most important week of the earnings season. As far as Nifty is concerned, 19,500 call. That is the one where we had the highest open interest, and they were taken to cleaners on Friday. Look at that. Premium doubling and open interest coming down by nearly 1/3. Some resistance at 19,650. But you know what? It's taken 10 days for Nifty to move from that 19,000 to 19,500. And that 21-day move from 19,000 to 20,000 is still on. And my sense is in July itself, you should be hitting 20,000.
Anuj, okay, 20,000, not too far, right? I mean, just about 500 points on the Nifty and we'll be there. That psychological mark. But Anuj, you had made this point, I think, a couple of months ago on IT and how that reversal could play out. Some of it perhaps already played through with the 52-week highs last week. But you reckon, I mean, technically at least, is there more to go?
I think there is, Sonia, like I explained, this is one sector where you have comfort. And one more reason, I had interviewed Rhythm about 2 months back, and one very good point he had made was in stock markets, the point of maximum uncertainty leads to the point of maximum gain. Because, companies themselves were saying that we don't have visibility of 8 to 10 days. Forget about, 8 to 10 months. Normally, that's the price at which you get the best risk to reward. And the other thing is Infosys this time bottomed out at 17 times. Normally, in the past 4 or 5 times, it's either bottomed out at 13 times or 17 times. So it's done that at 17 times. Now, it had a big rally on Friday, so perhaps there could be some consolidation. But the fact that it's made some kind of a bottom, I think is there on the screen. And there's still valuation comfort. And the market hopes that from here on the valuations can only improve. So maybe there could be some more rally.
Okay, Anuj, thanks a lot for that. Well, time to get in our technical experts. Then we have Mitesh Thakur as well as Sudarshan Sukhani who join us on the show. Good morning, gentlemen. Sudarshan, what is your call on the Nifty? Upside levels are just being taken out. How would you approach trade today?
Good morning. There has been only one approach to the Nifty from my side, and that is to buy every dip. See, this market has gone up from 16,800 to 19,600. This is a bull market. You don't even consider going short in such a market. Your markets can go down for a day, half a day, but that's not tradable. The trade is to be on the long side. And that's important to understand. Even today, when the Nifty is at lifetime new highs, again, we have to wait for small intraday dips and go long. Our stop loss should be 19,300 now, and the stop loss is getting raised day after day, and that's good enough. But with that stop, we want to be long in the Nifty, and we won't worry about where the market is going, about valuations, nothing to think. Just go with the flow. The flow is very clearly on the upside. But The Bank Nifty has disappointed, unfortunately. Now, something can happen today that's different, but the steady decline in the Bank Nifty, earlier I thought it was a bullish flag, but that decline seems to be continuing, and therefore the Bank Nifty is best avoided. Focus entirely on the Nifty.
Point taken, gentlemen. Good morning, Sudarshan and Mitesh. The question is, if banks continue to falter, will IT pick up some of that slack? I mean, two large sectors with 30-35% weight each in the market. That's the Finance Minister, Nirmala Sitharaman, addressing the press. Let's just dip in for a quick bit, listen in.
These exchanges serve as a testament to our mutual commitment to nurture a robust partnership and harness the potential for progress and prosperity. The state visit of the Honorable Prime Minister, Shri Narendra Modi ji, to the United States last month and his meeting with the US President have enhanced the strength and dynamism of the partnership. The historic visit paved the way for new avenues of collaboration, propelling our partnership to a greater height. Today, our discussions highlight the commitment of India and the United States to actively further the G20 agenda, and these include addressing critical global issues such as strengthening the multilateral development banks and taking coordinated climate action, facilitating consensus to intractable issues associated with rising indebtedness of low and middle income countries, and harnessing opportunities presented by crypto assets and digital public infrastructure for financial inclusion. I also look forward to furthering our bilateral interests through development cooperation and new investment opportunities through alternate investment platforms for renewable energy. As we look ahead, we reaffirm our commitment to achieve substantial outcomes through close engagement. By leveraging each other's expertise and resources, we actively promote economic growth, foster innovation, and drive sustainable development. Our partnership will create a prosperous and equitable future, making it a catalyst for positive change worldwide. I now request Dr. Ellen, U.S. Treasury Secretary, to make her remarks.
Thank you, Minister Sitharaman. I appreciate the warm welcome. This is my third trip to India as Secretary of the Treasury, and I value the opportunity to meet with you on all these occasions. The United States has appreciated India's leadership during its G20 presidency, and we will continue our close cooperation. The world is looking to the G20 to make progress on key challenges like climate change and pandemics as part of our work to strengthen the global economy and to support developing countries. I'm hopeful we can take significant concrete steps forward in our meetings. I appreciate India's demonstrated leadership on debt issues as G20 president, including your support for G20 efforts to improve the multilateral debt restructuring process. I also welcome India's focus on advancing the evolution of the multilateral development banks, or MDBs. It's vital that we use meetings like this to strengthen our coalition of shareholders that are working together to press for more ambition and specific reforms with respect to the MDB's vision, incentive structures, operational approaches, and financial capacity to better address global challenges. We estimate that the MDBs as a system could unlock $200 billion over the next decade just from the measures already being implemented or under deliberation as part of this process. The recently released G20 MDB Experts Group report is one recent useful input to this work. though we must only explore capital increases after the reforms in these areas have progressed further. We're also proud to have supported Ajay Banga's candidacy to lead the World Bank, and we believe he's providing the right leadership to deliver on these critical reforms. It's also important to address the immediate need to boost the bank's concessional lending capacity for global challenges and support low-income countries to supplement ongoing efforts. An Indian partnership in this effort will be a key to its success. Beyond our cooperation at the G20, we highly value our bilateral relationship with India. As illustrated by Prime Minister Modi's recent state visit to Washington, the United States and India are among the closest partners in the world, and I've been proud to help lead our work on that relationship. The United States is home to the largest Indian diaspora outside of Asia, and it serves as India's largest export market. Bilateral trade between our two countries reached an all-time high last year, and we expect it to grow further in the years to come.
Okay, plenty of stocks in focus. So let's get the views of our technical experts in. Mitesh Thakkar and Sudarshan Sukhani is still with us. Mitesh, what's your view on the index? And, if you can take us through your individual stock ideas as well.
Good morning. So I think the important thing which happened on Friday was getting past that 19,520 mark. And therefore, I think, we would now suggest trailing the stop loss to about 19,450 on your long position. So as long as that has not been taken out on the Nifty, stay long. The Bank Nifty is slightly a worry. I would still want to see it get past 45,120. And if that happens, then I think the Bank Nifty should catch some momentum on the upside as well. But the Nifty IT till then is doing very well. It's about to hit a weekly level of around 31,200. But once it breaks that, then I think the 33,500 kind of target can be looked at. So very positive setup on the Nifty IT should compensate a good part of the Bank Nifty underperformance. Having said that, on the stock side, I have 4 buy calls, with 2 of them from the IT sector. Wipro is a buy with a stop at 397, targets of 422 here. Intellect Design is a buy. Keep a stop at 628, look for targets of 665. Also a buy on Hero Motors with a stop at 3090 for targets of 3200. And Divi's Lab is a buy with a stop below 3645 for targets of around 3750.
Okay, all right. Thanks for that, Mitesh. Well, Sudarshan, you give us a call on the index, but give us individual stock calls as well, please.
Sure. See, Asian Paints is a buying opportunity. The stock has been in a classic uptrend, higher highs, higher lows. Now it's probably resuming its upward move after a sideways channel. Buy with a stop under 33.85. Oro Pharma is the second buy idea. This market is waiting for stocks to be bought into. So Oro Pharma is another buy idea. Big up move. Now a small correction that looks like a bullish flag. It should break on the upside. Buy with a stop under 720. My only intraday short is Jubilant Foods, where suddenly the stock has given signs of a large distribution. It's an intraday short with a stop above 478. And finally, my last stock is also a buy. It's the same as Mitesh has, Hero MotoCorp. Hero MotoCorp has already broken on the upside from a small bullish flag. That's pretty decent. Buy with a stop under 3,040. Primarily, stay on the long side.
Okay, stay on the long side. Well, thanks a lot for that, Sudarshan and Mitesh. For now, the pre-opening rates are settling at 19,600. So we're just, 400 points away from that 20,000 psychological mark. Just keep an eye out on a couple of stocks. Avenue Supermarts, weak numbers coming through. ONGC, the government has hiked windfall tax. So both ONGC and Oil India are actually in the red right now. And something like, Thangamel Jewelry, by the way, that stock is going ex-bonus today. So don't be, shocked by the move on that one. There's ex-bonus on Thangamel Jewelry, and a couple of other stocks like Bandhan Bank as well have seen asset quality pressure. But Prashant has moved to the big wall to talk about some of the stock moves in his market laser segment. Prashant, over to you.
Well, thanks very much for that. So I'm going to go maybe a little bit against consensus. The wisdom is, and absolutely I agree with it, that in uptrends, you stay with the trend. Don't look for ideas to short or to sell. But maybe you can keep some things on the watch list, right? This is not a recommendation to either go long or short, but just a kind of a watch list, which perhaps is expected to prepare you for what may come. Angel One is the stock that I'm putting up on my sort of screen here. And it's a pretty simple, straightforward daily chart, which I think makes the point. This is the rising trend line, which has been in place for 2 months straight. From the lows in May all the way to where we are right now. As you can see, there are various touch points on this. And Angel One, with these touch points, has risen 45% in the last 2 months or so. We are exactly as of Friday's close on this trend line at about 1708, which was the closing price. And this is the reason why I'm saying a break below this perhaps can, lead to some damage here on the stock. Just a couple of things, right? As I said, big 45% stock rally in just 2 months. I think that is the starting point. Momentum is pretty strong. But at the margin, there are perhaps, some negative factors. So NSE's order, which we highlighted earlier, prohibiting onboarding of new APs, perhaps hurts broking and distribution income, which is a pretty large, chunky sort of income stream for Angel One. From the 1st of July, by the way, client bank guarantees cannot be used towards margin money. Perhaps this is going to lead to some increase in working capital, etc. So this is something which is going to happen, which perhaps I think which we need to keep in mind. On the other hand, capital market activity remains pretty strong. Markets are buoyant, and brokerage income, is highly dependent on that. The stock is inexpensive as well, so it's not as if this is one of those stocks. The ideal setup is where valuations are completely out of whack, and you have some negatives which start to come in, and the stock cracks. Which is not exactly the setup here. The stock is relatively inexpensive at about 15 times FY24 earnings. It's expected to clock between 12 and 15% growth over the next 2-3 years, according to consensus expectations. But keep an eye on this one. I think it starts straight away with a 5% cut, which is below that trend line that I put out. But I think a close is always important for the future trajectory on your radar. Back to you.
Okay, all right. Thanks a lot for that, Prashant. Well, let's focus on a couple of other stocks then that will be reacting to numbers. Avenue Supermarts, we have a bull versus bear. Manglam joins us to run us through a couple of views on that one. Manglam.
Well, let's start with the bear case, because UBS has said that there has been slow pickup in demand for discretionary products. In fact, as a result of which gross margins have been impacted, sales per square feet on a compounded basis has been negative over the last 4 years. And in the near term as well, they believe that this weakness could continue, as a result of which they have a sell rating and a target price of 3,700 rupees on the stock. On the flip side, there are a couple of bulls as well. We start with Motilal Oswal. They say that the adverse impact from larger size stores is now bottoming out. In fact, in this quarter, both the revenue per square store as well as the revenue per square feet have increased by around 4 to 5% year on year. And the company has added their strong store footprint. So as a result of which, some cost management and recovery in discretionary could do extremely well for them. They reiterate their buy on the stock. In fact, Macquarie also believes that, the management commentary bolsters their view of this weakness in the company's discretionary demand just being cyclical, as a result of which they expect solid EPS growth on improving general merchandise sales. So that's the key monitorable going ahead. They too reiterate their outperform rating with a target price of 44.50 on DMart.
Okay, so split down the middle there. Abneesh Roy, the executive director at Nuvama, is with us. Abneesh, which part of the camp do you belong to? I mean, I was going through your note where you have sort of adjusted your profit estimates downwards for FY24. But tell us about, the target price, other earnings expectations as well.
Sure. Thanks. So we expect Avenue Supermart stock to be under slight pressure in the near term because of the miss, almost 10% miss in terms of the EBITDA. Definitely, the other issue is apparel slowdown. So if you see, they are pointed towards definitely apparel and merchandise percentage are clearly lower. And that's why there is a gross margin pressure in terms of the past few quarters, and YOY also it is there. So the other issue for Avenue Supermart this quarter has been clearly store addition. Only 3 stores were added versus their full year number, which I think most analysts would be building will be around 50. So these two have really impacted the numbers. The revenue update had already come few days back. So that's why 3% cut in our numbers. We have a target price of 4015. So we expect the stock to be under pressure in the near term. But from a 2 years perspective, this is a good compounding story because of 3 reasons. So if you see, the store addition always is bunched up, and that's true for most retailers. because of so many approvals needed. So you will see suddenly one of the quarters very high addition also. So we remain confident that they should be able to meet the 50 store number. Second is quarter on quarter, there is an improvement in terms of gross margin by 120 bips. And they have pointed that the general merchandise percentage is improving. Our concern remains on apparel. So apparel slowdown is across the board, except the lower end. So there definitely all players are facing an issue. Third is, of course, this is seen as a good proxy to the overall consumption compounding story and huge runway to add stores in the other states also, ex of Gujarat and Maharashtra. Plus, the competition from hyperlocal is abating because they are focusing on profit. So it's a good long-term story, but near-term there should be some pressure. We have a target price of 4015.
All right, Abneesh, got that pretty clear. Quickly, Abneesh, we're running to market opening, but if you could tell us, Reliance Retail's listing could be in the offing. Now, that's what the street is building in. What does it do to a stock like DMart? Does it justify these premium multiples, or does it pull away the scarcity premium? So in that case, will it be negative for it?
No, I would say that overall, because of the overall liquidity coming into the market, FIs pumping so much of money, this is a stock which FIs also like from longer term perspective. So I would say that that kind of event should in fact re-rate the stock. Reliance Retail is far more diversified, and definitely in the core grocery, DMart is extremely well placed. So I would say yes, that should turn out positive from a medium longer term perspective.
All right, thanks a lot for that. We're just heading into the market opening, so let's keep our eyes peeled on the headline index. Looks like it's going to be a positive opening. That's what the indications are, about 50 points in the green for the pre-opening rates. Remember, the Nifty closed at all-time highs last week. That 19,500 mark was conquered. And the momentum is very, very strong in the market. There was large foreign investor buying as well. 2 days in a row of over 2,000 crores of buying in a single trading session. So it looks like the market is going to be cheerful today as well. Couple of stocks could be under pressure like Avenue, Bandhan, Angel One, etc. So we'll talk about them as well. But overall, the market, is in fine shape and could be pulling on to new highs yet again. There you go, 30 points in the green on the Nifty. So the start is decent. The sensex is up about 120 odd points. Sensex is in fact scaling well past the 66,000 mark as well. The mid-cap index is up about 110 points. So the mid-cap index today, just for the opening tick, is doing better than the frontliners. And the Bank Nifty is also pulling its weight. So now up almost 80 points on the Bank Nifty. What's leading from the front this morning is the Power Grid, Adani group of stocks, Adani Enterprises, Adani Ports. You have Bajaj Finance that's in the green. Bajaj Auto is trending higher. Couple of names in the auto space like M&M looking pretty good, so don't lose sight of that. And something like a Wipro is not too bad. On the downside, Infosys ahead of its numbers this week. The numbers come out on 20th, which is Thursday. Ahead of that, it's slightly choppy, Infosys. TCS also struggling a tad bit this morning. Hindalco, Eicher Motors and JSW Steel, a couple of other stocks that are trending a little bit in the red. And ONGC on the back of that windfall tax is down about 0.5%. But few and far between really. It's largely a market that's trending in the green. Trying to build on to its gains, but it's early moments just yet. The advance decline ratio is solid in favor of advances and not too bad. Like I said, the mid-cap index is outperforming the frontliners. So there is definitely, the breadth of the market is pretty good.
Well, that's right, Sonia. Some stocks that have been doing well, they continue to do well. Precision Camshaft, that stock was up 20% on Friday. That's up another, I think, 10% odd in today's trading session. Atul Auto as well, that's up close to around 8%. Volumes as well reasonably high. And this renewable energy space, well, out there you see a lot of tailwinds out there, a lot of order wins as well. Suzlon as well as Inox Wind, both of them are higher in today's trading session. But let's get to some earnings reactions then. JSW Energy, that's under pressure. Avenue Supermarts as well has opened up with a cut in today's trading session. That's down a couple of percent points. Bandhan Bank reacting to its numbers. Well, Abhishek told us those numbers were a little bit weakish. And now it'll be interesting to see how they go ahead and achieve the 20% growth that they're targeting. Rallis, the numbers were a little bit weakish, maybe not as weak as expected, but it was still a weak set of numbers. I think Rallis as well was down close to 100%. CCL products, nobody's on the top line, but we had some bit of margin compression that we saw. In fact, Rallis has moved into the green. Sonal said those numbers are not as bad as expected. So explains why from a negative 1%, it's up close to 100%. On the flip side, you have Just Dial. The numbers look good. Good growth, good margins, good visibility, good cash in the books. Gets a tick mark on all those fronts, and Just Dial is up close to around 3%. Keystone Industries, let's see whether we're getting an initial rate. Well, those numbers were more or less in line. You don't have really any estimates out there. But there was an improving trend, so the street will like that, and valuations give some support. Prashant, what else?
So you got about 3:1 in terms of advances to decline ratio. So this is, while the Nifty is given up gains, it's up just 18 points or so. Remember, both the mid and the small cap parts of the market rallied pretty hard on Friday. I mean, 1.5%, 1% respectively. So I think bulk of the action there. So just a few more names. Suzlon is coming up with a 4% gain. It's at 18 rupees now. We've got Aarti Drugs, which is coming up with a 7% pop on volumes, 531. Manappuram, I think, got positive news flow on Friday with the court basically staying all proceedings, ED proceedings against the company. Stock was up. It gave up gains from the high on Friday, but it's up 3% this morning, 132. There is a Precision, I think, camshaft we pointed out. Atul Auto is up 9%. Atul Auto is up at about 364, Atul Auto. Karur Vysya Bank is up 5%, 129. And what else? I mean, Daawat, some of these smaller companies, and I'll have to go down and find stuff where volumes are not that high. So we'll avoid that. On the downside, Bandhan is down 2%. Angel is down 5%. Angel we highlighted in the morning. But, I mean, watch for the close. It's below, obviously, it's below the sort of rising trend line that I highlighted for the last 2 months. But it opened 5% lower. So incrementally, what are you able to do, I think will depend on the close. DMart is down 1. We just discussed that with Abnish. JSW is down 3 on the back of earnings. Chennai Petro is down about 2.5%. Satin Credit Care, Marico, ONGC are some of the others which are down between 1.5 to 3.5%. So that's basically the price action. The Nifty is now gone flat, just 15 points on it.
I just want to mention one stock, and we mentioned it last week as well, in the consumer durable space, Polycab. Fresh highs on that one, and we did this, analysis on what the earnings would look like for Q1, expected to be very strong in both cables and wires business. Last quarter was also very strong. So, this is that theme that's playing out, the home improvement theme, post real estate doing very well. This entire pocket has moved with so much strength. So that was at a new high today.
Absolutely. 39.34 on Polycab. Stocks doing very well, 1.5% higher. We have Sanjeev Prasad now joining us, Managing Director, Co-Head at Kotak Institutional Equities, to take some questions. Sanjeev, good morning. It's always a pleasure having you with us here on the program. The global narrative, which you've highlighted in past interactions, is perhaps a potential headwind down the line. That headwind is receding. At least it seems like that at this point in time. Bond yields have come off. The dollar has crashed over the last just 5 or 6 days. How are things looking as you look at prospects for the market near to medium term here?
There are two parts, Prashant, over here. One is what's happening on the bond yield part. So as far as the macroeconomic situation is concerned, people are assuming there will be some, pause as far as rates are concerned, rate increase are concerned to central banks going forward. US Fed will probably do one more round in July, and that's about it. So that is something which is getting priced in currently. What is not getting priced in, I guess, is what could be the impact of all the rate increases which the central banks have taken over a period of time on the economic activity. If you look at the US in particular, economic activity continues to be fairly robust, which means the US Fed has no option but, I guess, to keep rates at a higher level for a longish period of time. So what does it do to economic activity over a period of time and earnings numbers, etc.? That will play out. So as of now, the market is more focused on the first part, which is speaking of inflation and interest rates, and not that much focused, I guess, on the negative part, which could play out over the next 6 months in terms of lower economic activity.
Okay. How are you feeling now, Sanjeev, about the IT space? It's come back after a while. The earnings were not great. I mean, the management commentary was also cautious for a lot of these big tech companies. But prices have come back. What's your view?
I don't know. I mean, honestly, the reaction was a bit of a surprise. I guess somewhere the feeling is that what's in the stock price in terms of 1Q FY24 results being probably the bottom in terms of disappointments in terms of either top line or profitability. And from here on, things would improve. I'm not sure how that will exactly happen because so far we haven't really seen a big global slowdown. there has only been talk of a slowdown, but no real slowdown for whatever reasons. And actually, a second half slowdown is there, which we assume will be the case as far as global economic activity is concerned. I'm not very sure you will suddenly see a big pickup in discretionary spending by the IT sector, the consumers of the IT services companies. So I think this still has to play out in terms of probably more earning downgrades going forward.
Hi, Sanjeev. Good morning. Sanjeev, we are tracking the flows and they've been rock solid with regard to the hot money that's coming, the FI flows. The DIs was taking some money off the table. But I wanted to ask you, what are you making of this promoter selling? I think the past couple of months, we have seen the highest amount of promoter selling. Is it a cause of worry that could be viewed negatively? Or do you think the depth of the market is such that you're getting good quality investors that are coming in, that good quality institutions that want to be part of companies, and you would actually view it positively?
The insiders are selling, you need to be careful here. I mean, they are probably are the ones who know the best about their companies, and we have seen a whole lot of selling by promoters, PE, entities, and so on and so forth. So I guess the mood of the market is very, very bullish as of now. And looking at the valuation, some of the promoters themselves will be taking a call, to reduce their position. I'm a bit surprised because normally, promoters should be holding on to their stocks forever. But if they are taking a call that the valuations are too high, I really don't want to argue against that. The market may have its own, take on this. But if promoters are selling, you need to be careful, I would assume. Unless until it's something to do with, minimum public shareholding, or if the company has to bring it down to 70%, that's a separate issue. But if that's not the case and the promoters are selling, then I guess, they themselves may not be finding too much value in the company at this point in time.
Got that. Sanjeev, from here on, what changes should one make? I mean, recalibrating IT, for example, would you say that buying a sort of a IT-based kind of product makes sense from here? IT services, do you think that is still... people have been waiting for this US recession for a while and how it will hurt growth for especially large cap IT. Mid cap and small cap IT has done very well. What's your sense?
No, I would continue to be underweight on IT. Look, if you look at the US, as I was saying, the economic activity is still very high, and the reasons for that. So if you look at the households, for example, their consumption is not really slowing down. Household debt is actually fairly manageable over there. There is no real impact of higher interest rates on household debt or repayment, for the simple reason most of the debt related to mortgage is at a much lower level. So there is no real impact of higher interest rates on consumption as yet. Number two, households sitting on a huge amount of excess financial savings because last 3 years we had a lot of financial giveaway by the US government. All that will start running down by September from whatever calculation we have done. Then you had a lot of debt forgiveness or debt postponement, repayment postponement of student loans, etc. Even that will start coming back going forward. So if I put all this together, I suspect the US consumption, which is still holding up reasonably well, and also there's one more factor, by the way. You've also had fairly stiff increases in wages. So it's not as if the households are feeling the pinch of a higher inflation. So over time, as some of these positive factors start fading out, US consumption has to slow down, in my view. Parts of it is slowing down, the more the household new house purchases, for example, but the consumption part is still holding up reasonably strong based on the factor which I highlighted. So as and when things actually start slowing down in the US, I would suppose, companies would be a lot more careful about, what kind of spending they want to get into when the US is actually slowing down or, God forbid, even going into a recession. So let's see how things pan out. I would be a bit cautious on IT at this point in time.
Okay, cautious on IT, but I don't think the market is cautious on IT. Just look at that. Barring TCS, all IT stocks are trending in the green right now. And the Nifty IT index, in fact, this month is up almost 5%. So, that's been the kind of rally. By the way, lots happening in Route Mobile, as you can see. The promoter is looking to sell its entire stake. stake representing about 57%. So Route Mobile, is the stock in focus right now, 6.5% higher. We'll get more details on that. But in the meantime, I also wanted your thoughts, Sanjeev, on what's happening with some of these spaces that have rallied hard this year, which is, spaces like autos. Is there more upsides here in names like, say, an M&M or a Bajaj Auto, which have already rallied about 25-30%? And if not, how do you approach that space now?
Not much, Sonia, to be honest with you. All the stocks have rallied on expectations of big improvement in profitability going forward, which will happen. Obviously, you have seen a big decline in raw materials, whether it is metal, plastic, rubber, everything. Prices have come off pretty sharply in the second half of FY23. So based on that, you have seen a reasonably big jump in 4Q FY23 gross margin, EBITDA margin. That will sustain in first half of FY24. But having said that, the volume numbers are absolutely disastrous for just about every auto company, barring M&M and Tata Motors passenger vehicle volumes. If you look at on a 4-year CAGR basis, in most cases, volumes are flat or down significantly, even down 8-9% 4-year CAGR, which is like something like 40-50% down compared to 2019 levels. So I'm not very sure, whether I should be playing the shorter term improvement in profitability or worrying about volumes. And more important, there is a lot of disruption coming in the sector going forward. And the multiples really don't factor any sort of disruption which is coming in, whether it is the two-wheeler space, more competition coming in from the EV side, or whether the four-wheeler space, same problem over there. So if you have a combination of, somewhat muted demand, more competition coming in, and companies sitting on very high profitability profit pools, I think they're all ready for disruption. They will all decline going forward, and multiples will, come off very sharply from where they are. So autos are a strict no-no for me at this point in time.
Okay, all right. Sanjeev, we'll leave it at that. Thanks a lot for joining in and, talking about the market as well as what's been happening. By the way, Route Mobile is really the stock of the moment, 8% higher now on that stock. After the sale of shares under the agreement, the promoters have sold their entire stake, and I think it's done at 1,626 rupees a share. Proximus will be buying about 57.5% stake in Route Mobile for, I think, about 650 million euros. So promoters are selling stake, and now new promoters have come in, Proximus Opel Group, and Route Mobile is up about 7.5%. So we'll talk about that in greater detail, but let's get you some more corporate interaction. It was a muted quarter for JSW Energy as coal prices declined, and that hit realizations. Although the acquisitions have been contributing very well, Prashant Jain, the joint MD and CEO at JSW Energy, joins us now to talk about that. Prashant, thanks a lot for joining in. So as I said, with the way the coal prices have been moving, there was a bit of pressure on the earnings as well. Just wanted to start by asking you about the realizations. What do you think the realizations could be in the next couple of quarters? And how do you see coal prices move from here? Is it a possibility that you could perhaps achieve that 1,600 to 1,650 or maybe 1,600 to 1,700 crores EBITDA target going forward?
So 1,600, 1,650 crore target, which we had given for the renewable energy for the Mitra asset, I think, and we are absolutely on course of that. That target we gave for FY25, but I think we will be doing much better than that, and it will be achieved much ahead of the schedule. As regards to the power prices which you talked about, as well as the contribution, the power prices are quite robust given the trend of the monsoon. What we are having, we have never seen that 5.5 rupees power prices during the monsoon period, and then coal prices have really cooled off. Now they are in a double digit, and which gives us quite a good robust EBITDA margin and a contribution in the merchant sales. So power demand is also picking up during the July. Now we are seeing 5.5% power demand growth, and similar was the trend we saw in the month of April also. Of course, similar was the trend month of in the June, but April and May, due to the unseasonal rains, the power demand really was very bad, and because of that, you saw the power demand growth was only 1% during the last quarter.
Okay, I just had a follow-up for this Mitra. You said 1,600 to 1,650 crore EBITDA target is on track. Can you tell us what has the impact been of the refinancing interest cost burden? I mean, how much would your interest costs go up by? And what would the debt to EBITDA be going forward?
So for our entire portfolio, we have given the guidance that the debt to EBITDA will be in the range of 3.5 to 4 times. And we are, as a company as a whole, at this point of time, is 3.5 times on the operating asset. And in terms of the refinancing cost during the last quarter, there was close to 45 crore rupees impact. And in order to see that the total quarter gone by, our EBITDA would have been up by at least 110 crores as compared to what we have already shown. So our EBITDA improved by 19% as compared to previous year same quarter, but it would have been 30% up, close to 1,410 odd crores, because around 80 crore of the EBITDA, which we are going to recoup in the balance 3 quarter from our hydro and Barmer asset, which are on the total PPA, but we had a lower generation and which will be totally recouped. And around 30 odd crore of the EBITDA of Mitra, which was not consolidated on time because of the refinancing of some of the SPVs which we had undertaken. Otherwise, the Mitra EBITDA, which we had disclosed at 370 crore, was actually 401 crore.
All right. Hi, Mr. Chen. Good morning. So what will be the steady state finance cost per quarter? As of the last quarter, it was close to 486. As you said, there is some part of which is a one-off. So what is the steady state you're looking at going ahead on a quarterly basis? And also, given that you're doing some acquisitions which the street has read positively, there's no risk, right, from rating agencies with regard to cutting their ratings on the company? You think it's fine?
So, two things, that our total weighted average interest cost is 8.65% for the entire company as a whole. And similar is for the Mitra asset. So, for example, Mitra, we are having 8,600 odd crore of the total debt and at 8.6%. So this will be something like around 700 odd crore will be the annualized interest cost on Mitra asset. And as regards to the rating agencies, we had already disclosed our total plan up to FY30, and wherein we have been talking about that how we are going to maintain our leverage ratios as well as also debt to EBITDA ratios, and they are absolutely comfortable up to 4.5 times debt EBITDA, whereas we are operating at this point of time 3.5 times.
Mr. Jain, hi, good morning. The other one, the In-Bharat acquisition, what is the status of that for sort of the unit 2, which is under construction, unit 1, and that entire capacity will be kept for the merchant market, right? So that'll be a big kicker when that all of that comes in.
So we opened the turbines post we took over the asset, and then we were very positively surprised with the condition of the asset. So that's quite a good positive indicator. We had planned that both the units we will be putting into the commissioning between 12 to 18 months time frame, whereas we are now quite optimistic that during the month of September or October we will be putting first unit into the production. And in fact, the current month the unit is going to be on bar, and second unit we are expecting that within the current financial year we will be commissioning. Of course, both these units we are going to keep into the merchant market for the time being, because we see that there is quite a big opportunity at this point of time. At some point of time, maybe 3-4 years later, we will look at to put that onto the long-term PPA.
So there is some, because I think unit 1 was supposed to come on stream, was supposed to be operational in the first half, right? So could this get delayed a little bit more? You're saying September, October, and unit 2 will get the construction will finish this year, this financial year.
No, it's the other way around, Prashant. The first unit was supposed to come after 12 months. That means time in the FY25, and second unit by October 25. But because of the condition, it is going to get preponed, and we will be doing other way around.
Sure. Since the entire focus now has moved to the renewable energy space, I want to ask you a little more about that. Last time you alluded to, some amount of value unlocking that you're looking at in your renewable arm, JSW Neo. Any progress on that front, and what's the prospects with that arm?
So the discussions are on. We are in discussion with some of the strategic investors who are very keen to take a pie into the Neo business. But I cannot put any kind of a timeline that when it is going to happen. But at some point of time, there will be a value unlocking event which we will be undertaking.
Oh. All right, some point there'll be a value unlocking. Okay, we will come back to you later for that. Thanks a lot for joining in and appreciate your thoughts. That's JSW Energy. Let's take a quick commercial break. Markets are very, very quiet. We'll come back with lots more.
Welcome back. Well, let's get straight to our next management. Bandhan Bank, that's a stock in focus. The operational weakness continued for the bank in the first quarter. The MFI book saw a sharp decline and asset quality remains under some stress. For FY24, the management has given a loan guidance of close to around 20%. To understand more about how they want to go about achieving this, we're joined by Mr. Chandrasekhar Ghosh, the MD and CEO of the company. Good morning, Mr. Ghosh. Well, it appears it was a bit of a rough quarter for you, but you've maintained your guidance of close to around 20%. Tell us, how do you plan on achieving this? Because for the first quarter, you have achieved single digits. If you need to achieve that 20% odd, you'll have to do mid-20 growth for the remainder of this year. And also your MFI book has degrown. So how sure are you of getting to this 20%? And how do you see the MFI book recovering?
Thank you. The growth of the MFI book is a seasonality. If I mentioned on that, the last year, first quarter, our MFI book have been down in the 5,000 crores. And this year also is the 5,000 crores. Last year, we have been disbursed in this quarter as a 8,200 crores. And this year, this quarter, we have been disbursed the 8,000 crores. So it is in very similarity of seasonality in the first quarter. And the second quarter, before the 1 month of Puja, it will start the disbursement again in the back to the position. And the continuously it will become, so that will be like to reach in this, the percentage which we are guided to the market on 20% will be reached.
Sir, good morning, Prashant this side. Two questions, sir. One, based on the loan growth figures for the quarter, should one sort of open a downside watch to the full year loan growth figure of 20%, which you've been guiding for? That is one. And second, because of all the unfortunate incidents of flooding and damage to property, etc., because of the excessive rainfall in especially the north, is there going to be any impact in Q2? I mean, have you done any sort of damage assessment for your book?
No, if we see that as per the first quarter, April, May, we have been seeing some down. June has come to the normal. And July half already done is a good way to making. So that whatever the rainfall happened, it is not impacted to my book. And we are predicted on that the farmers will be like to plant their paddy. And they have the good demand. And the demand will be like to fulfill, will be fully started from August and onwards. So that my 20% the guided to growth of this financial year, I have the confidence on that will be reached on this.
Okay, confident on the 20% growth. The issue, Mr. Ghosh, is on asset quality as well. Stress has risen significantly, especially your slippages, almost at 1,400 crores now compared to 1,100 crores last quarter. What went so wrong? And can you guide us for what the gross NPAs and the slippages could be in the ballpark range in the upcoming quarters?
No, if you see that the last quarter, it was in 1,100 crores plus. And this quarter has come to this 13.65 crores, 1,300 crores on that. So if out of these 1,300 crores, 215 crores has come technically from housing loan, and we are 160 out of 215 crores already recovered on that. For that reason, the last quarter and the slippage and this quarter slippage are similar amount. And though it is a seasonality is there in this quarter, but the next quarter it will be again started to the come down, and you know that collection efficiency also improving. So that will be helped us on that to better collection efficiency and slippage coming down to the next quarter.
Okay, so you're saying that this quarter is impacted because of seasonality and it will get adjusted next quarter. So just on an average, by the end of FY24, where do you see your gross NPAs? Because they are almost at 6.8% now. Could you bring it down by the end of the year? And on the slippages average number as well, if you can help us, by the end of the year, what are you looking at?
No, if you see that the 6.8%, it is 6.7%, it has come to these two factors on that. One factor is my business growth has come down. It has been impacted to this, the NPA percentage showing high. Second point on the 583 crores, we are having the ECLGS loan, which loan we are declared as a stressed earlier. But as per new circular has come to this quarter, it will be like to declared as an NPA. So that we have been declared as a NPA, so that these two factors have been showing it as an increase of the percentage. So though it is a government guarantee is there 583 crores, by this year this money will be returned back. And you also know that CGFMU also money is returning back. And third point, whatever we are recovered the money from the NPA customer, and that the money, major portion of that money we have given to the ARC, and which will be closed this quarter. Their money, whatever they have a demand, it will be paid by them. And third quarter onwards, whatever the collection will come, which have been, it will be like to effect to my book, and automatically NPA percentage will come down, which we are guided 2% in this financial year, March 24.
All right. So slippages quarterly numbers, sir, will come down to what?
Quarterly, if I say that the quarter-on-quarter basis, it will be come on that. The two factors will be work. One factor is a collection efficiency is going up now. So slippage is come down. Second is the recovery, whatever will be like to recover, 50% go to the ARC. And 50% coming to us. That will be also helped us to reduce the NPA amount. And third point, ECLGS and CGFMU money will become in this quarter. That also impacted my NPA reduce.
Okay. All right. Your NIMs, you're saying you'll maintain it between 7.5%, but your CASA has come down to 36%. Earlier, you had said that your target was to get it back to 40%. You still maintain that?
Yes. If you see that the NIM, it is maintaining on that 7.3% in this quarter, though it is in business, some of the profit loss. And it has been very good sign for the bank. We are maintaining it. We hope that the 7 to 7.5% will be like to get and continue as a NIM. If I come to the deposit growth of the bank has come 16.7% year-on-year basis. We have the good confidence with our deposit customers. They are coming and depositing their money on that. Second thing on that, if you see liabilities customer year-on-year basis, 11.5% increase. And 50% of my customer are transacting regular basis to the bank. That is 50% means the growth has come, 50% growth has come to the transaction the customer are doing in our bank, which helping us to more CASA deposit will come to the future. So growth has come good. Retail growth also has been continuous at 71%. And bulk deposit has come down. And CASA has come little bit down. Again, it will be come to up. And that will be like to help to the bank to maintain this, the CASA growth 40% in this financial year.
Okay, all right, 40% in this financial year. Thanks a lot for that, Mr. Ghosh. Appreciate your thoughts and all the best for the quarters to come. That is Bandhan Bank explaining what went wrong this quarter and how it's a seasonal factor that impacted their earnings, but things will improve going ahead. Let's now move to our special segment, Quarter Se Quarter Tak. Today, Sonal is with us to give us the expectations from the chemical sector. Sonal, over to you.
Thank you so much for that. Well, we've been highlighting slew of profit warnings coming in from global chemical majors, and that is something which will impact Indian players in Q1 as well. It is expected to be a weak quarter for both the chemicals and the agrochemical companies. For chemical companies, exports will see a major decline. This is due to slowdown in major markets like US and European Union as well. With China reopening, there is oversupply from that market. For agrochemical companies, there have been steep price corrections, and that has led to inventory loss and major destocking by clients as well. Highlighting few companies from the chemicals universe, there are a lot of companies. Many will be impacted as well. Starting with SRF, weakness will be seen in their refrigerant gas exports this time because they are mainly to the US, and there will be a decline in technical textiles as well due to high base. Hence, analysts expect a 23% decline in earnings for SRF. Aarti Industries has been indicating weakness in discretionary demand that will impact earnings again. Weak demand and price situation, and also the pressure in terms of market mix also will lead to a 37% decline in EBITDA. For UPL, Q4 was weak, and that will continue in Q1, leading to 11% revenue decline due to steep price corrections. Stress markets like North America, there's Europe, Brazil, etc. will impact gross margins, which are expected to decline 300 basis points on a YY basis. But there will be outliers, and two companies are expected to do well. Navin Fluorine will report strong YOY growth, but quarter-on-quarter will see a decline because of high base. YOY profit will grow 24%. For PI Industries, that will also see a strong growth. Double-digit growth is expected, and interestingly, it will be led by exports business. There could be some margin compression this time due to change in their product mix. Now, management commentary will be very important this quarter. For the likes of Atul Limited and Aarti, it will be on the export demand and recovery in discretionary demand. For Deepak Nitrite, phenol demand in domestic markets and global phenol acetone spreads will be key to track as well. And for UPL, it will be the impact of Chinese generics on pricing. In terms of valuations, UPL continues to trade at cheap valuations at around 13 times. We have SRF at 30 times. Navin Fluorine is comparatively expensive at 49 times. PI Industries at around 40 times. And Aarti Industries at 30 times.
Sonal, thanks very much for that. Ranjit Kirumala is Vice President Research, Agri, Chemicals and Midcaps at IIFL. Ranjit, good to have you with us here. Good morning. Pleasure. I just want to start with that last name, which my colleague Sonal mentioned, Aarti Industries. It's been many, many quarters of, I think, disappointment, and the stock perhaps is reflecting some of that. What is your assessment with this one? There are many people who've made a lot of money in this name, holding it over the years. You think it's at a point where it's starting to factor in the worst?
Yeah, good morning, Prashant. For Aarti Industries, what we have seen over the last few years is that there has been a bit of slippages on the execution front. The contract that was to give them a good growth, that unfortunately got terminated, though they have received the money, but those facilities, what we are seeing is that have taken time to kind of come to a full utilization. And on the portfolio front, you see the Aarti Industries has a relatively higher exposure when compared with its peers to a discretionary demand. And that way we have seen a bit of pain continuing over the last few quarters. So if you take the textile chemicals or the dyes and segment pigments, that's where we've seen a bit of pain continuing, and there the recovery is expected probably the next couple of quarters. So that is what the stock is currently factoring in. The capex remains strong, and hopefully that should start contributing. The management has given a guidance of 15% EBITDA growth for FY24, though remain confident of having a CAGR of 50% over the next 2 years. But with the weakness that we are seeing globally and mainly in the discretionary demand, we need to see whether that guidance would remain intact a couple of quarters down the line. So that's where the street is a bit concerned. But as you see, probably in the medium terms, the capex that they have done and that they are making should start contributing to that.
All right. Hi, Ranjit. Good morning. Ranjit, always good to hear you. And in fact, your alerts as well with regard to some of these prices and demand trends are spot on. So you've got that quite bang on, I think, in the last 12 to around 18 months or so. Ranjit, the problem is from year on, some part of the street believes that maybe we are in for peak earnings from some of these companies, and there's a risk to earnings from year on. Remember, it had a big phase of re-rating, and now we could be in a phase of a bit of a lull. Are you in that camp? Do you think that maybe the next 12 months or so at best we'll get sideways movements of these stocks?
Yeah, so we have seen a dream run for most of these chemical companies over the last few years. Some of them are ahead of the fundamentals at this point of time. And then what we are seeing is that the strong growth of few years, FY24 is likely to be a bit of subdued earnings growth. Most of these companies have a exposure to both domestic and are also on the import substitution story. What we are seeing on the export front is that most of the MNC companies have started raising profit warnings. For them, it's the first half of the results. So quite understandably, they are also toning down their guidance. If you look at the commentary, this is largely driven by the destocking, which is on the back of steep price correction that these companies are encountering. So that they remain hopeful that should get normalized in 1 or 2 quarters. So to that extent, for Indian chemical companies which are in higher exposure to these segments, we will see a bit of slowdown coming in. But we remain quite optimistic on the structural story of the chemical industry. So this is most long-term story where we do expect increasing outsourcing story to pick up. But as you rightly pointed out, since some of the companies have just gone a bit ahead of their fundamentals, so we do expect a bit of cooling probably in the near term. And most of these names should give us a good entry point so that the structural story is what one can still be in.
Okay. I wanted to particularly talk about Rallis, Ranjit. They reported numbers over the weekend. What did you make of the numbers, and what could this mean in terms of what Tata Chemicals could post? Because Q1 has seen price cuts from a lot of soda ash players as well. So what is the prognosis here?
So in Rallis, the results were largely in line with expectations, where we have seen domestic seeing a mid-single digit decline. The pain was in the international business, which declined by almost 30-odd%. So that kind of reiterates our prognosis for the 1Q, where we have said that steep price decline is what is likely to create the challenges. And that is where the performance was weak, but it was in line with our expectation. When you talk about Tata Chemicals, Rallis is just 10% of their EBITDA, so it does not impact either way. It's too small to move the needle for Tata Chemicals. Tata Chemicals is largely a soda ash player, and within that, the US operations is the one that moves the needle for them. We haven't seen much of a price correction. The pricing in the US has been largely stable. But due to opening of China, what we have seen is that there has been a bit of higher imports into India, and that's where we have seen almost 12% price corrections from the fourth quarter to 1 quarter. So that is what should impact the domestic EBITDA to an extent. Domestic EBITDA contributes around 26% of the overall EBITDA for Tata Chemicals. So we might see a bit of pain on that 26% of the EBITDA.
Okay. One final question. You expect Navin Fluorine and PI Industries to outperform. Both have exposure to the export markets, which has been kind of challenging. So what is working for these two companies that's perhaps not working for the others?
So if you look at 1Q preview, what we have highlighted is that it is a challenging quarter for most of the chemical companies, where we have seen that agrochemical have seen a steep price correction. On the chemicals front, there has been a weak demand, which is highly exposed to the discretionary side. But the contracted-led exports are still holding off well, and that's where we see a part of SRF, Navin, and PI are still doing well. For Navin, most of the Dahej capex got commissioned in the third quarter, so they have an easy base. We will see the growth continuing till the second quarter, and from the third quarter, that Dahej would be in the base. While for PI Industries, there is a product concentration, and the innovator has been upping the guidance on that front. The innovator follows a calendar year from October to September. So there again, we have a bit of comfort till second quarter. So these are the two things why we see Navin and PI will tend to outperform in the 1Q.
All right, Ranjit, we'll leave it there. Thank you very much for your time. It's always a pleasure speaking with you, and hope to have you back soon again on CNBC-TV18. Thank you. Okay, well, 30 points, by the way. So you're not flat, but is an index which is closer to 19,600. 30 points is neither here nor there, but the breadth is overwhelmingly positive. 3:1 is the overall NSE advanced decline ratio. We're well into today's session, so this is good to see. Z is up 5%. Z had a big move on Friday. I think Z was up 5% on Friday. And last week, by the way, was generally a good one. So I think from 185-ish kind of levels, last week it left at 216, and it's adding another 10-11 rupees on it as we speak. So that's a big one. And there's a very interesting chart setup as well on Z, which maybe we can put out a little later. Basically, it's breaking out of what is a downward sloping sort of trend line from the highs of December 2021. Yeah. So 7-quarter downward sloping trend line, and it's basically taking that out with this move that we have on Z. Emphasis is the other one, which I think was not there, with a big move, 4.5%. Emphasis. Subex, a smaller one, it's up 8% or so. A lot of these tech companies, Latent View, but smaller tech companies. Latent View is up 6.5%. Genus Power is up 6.5%. Stocks at about 191. Again, something which was not there with the large volumes and price action in the morning when we started. Precall is up 5%. There is Atul Auto, of course, started strong. It stays up about 8.5%. There is Ratnamani Metals, which is up about 6.5% as well. So lots of addition in the mid and small cap part of the market with the gains coming through. Mitesh is with us with a quick check on things. Mitesh, comment on Z and the move you're seeing there, and if it's tradable first, and then your thoughts on the market and your own trades.
So Z, I think, we had a big movement when there was this announcement of the court order, and then, we've seen some volatility. But the weekly charts have improved a lot. So I think the stock is now nearing the first target of 230, 235. But overall, I'm looking at a target of around 251 to about 252. That's the broad target area which I'm looking at. So there's still about 10% plus upside left, and I believe the stock will do it in the next 5 to 7 sessions. So quite positive. This is a buy on declines because you've seen 2 days of rally. I think it was up on Friday as well. So anything closer to about levels of 215, 216 would be a fantastic entry point if you can get it. Otherwise, if you're holding it, just hold and look to take some profits around the 251 mark. Having said that, on the stock side, I have 2 buy calls right now. 2 mid-cap names have come on the radar. Aarti Industries is something which is reversing after a big decline. So that's a buy with a stop at 454 and a target of 480 is what I'm looking at over here. And Indus Tower, after a few days of consolidation, is now giving signals of a break on the upside. So recommend buying this one with a stop at about 163 for targets of around 177.
Okay, all right. Thanks a lot for that, Mitesh. For the time being, though, we'll slip into a short break. On the other side, we'll be joined by Abhishek Bansal, the CFO of Just Dial, to discuss the past quarter's numbers. Stay tuned.
Welcome back. This market has now found itself a fresh set of wings. Just look at that. The Nifty is up about 55 odd points, not giving up on its gains of last week. In fact, relentless in terms of an up move. Just goes to show the strength of the market. The advanced decline ratio is very, very strong as we speak. And guess what? Today's move once again is powered by IT names. So Wipro, Infosys, HCL Tech, Tech Mahindra, all leading from the front this morning. Just goes to show that whether commentary is muted or not, positioning is important in the market. And, you know, the street was positioned on the muted side ahead of the numbers. And decent numbers, no major negative news flow is what led to, all of these stocks sort of moving in one trajectory, and that's upwards. So it's IT leading from the front, and the mid-cap index is looking very, very strong. Talking about the mid-caps, it's a good quarterly performance from Just Dial in Q1. It's the fourth straight quarter of a 30% plus growth for the company. Abhishek Bansal, who's the CFO of Just Dial, joins us now. Abhishek, thanks a lot for joining us. It's been a good quarter for you. Revenues are finally above the pre-COVID levels. Considering that you've been growing at 30% plus on the top line for the last 4 quarters, what would you be targeting by the end of the year?
See, as you rightly pointed out, the key metrics are shaping up very well. The most important traffic, 171 million users, was up 16% year on year. And the good part is it has come at a very lesser advertising spend versus pre-COVID levels. Our collections last year were up about 44% year on year, which is translating into revenue growth this particular year. And this specific quarter as well, our collections were up about 28% year on year. So overall, while we do not issue any explicit guidance, things are looking quite optimistic for the rest of the year as well.
No, that is good to hear. I just want to maybe nitpick, but your active paid campaigns growth at 10,000 this quarter is lower than the 16,000 to 18,000 that we saw in the prior 2 quarters. Could you tell us what was the reason for that?
So seasonally, March tends to be the strongest month for us, and April tends to be a bit weaker. That is what impacts sequential addition of paid campaigns. But overall, the way to look at it is that paid campaigns at 548,000 are at all-time high. And with the traffic trends shaping up, paid campaigns also should pick up growth in coming quarters.
All right, Abhishek, but can you put a number to that? Any guidance you can give on the active paid campaigns growth?
33% top line growth materialized as about 13 to 14% from paid campaigns and another about 18% from realizations. As we have maintained in the past, we would prefer revenue growth to be an optimal mix of both these parameters. So that way we expect sort of decent growth in both paid campaigns and realizations going forward.
Okay, so you spoke about realizations up 18%. Is it back above the pre-COVID levels?
Yes, definitely it is back above pre-COVID levels. And in last 2 to 3 quarters, while we have taken price hikes in specific geographies, tier 2, tier 3 cities have seen better price hikes, because when we enter these markets, we enter with very entry-level pricing of say 750 rupees a month, etc. And there is significant headroom for these cities to catch up with tier 1 cities as well.
That is interesting to hear. Could you tell us what is the gap between tier 1 and tier 2, tier 3 realizations that you spoke about? And is there headroom to grow these realizations from where you're at?
Sure. So tier 2, tier 3 cities on an average basis are only about 40-45% of tier 1 realizations, which means potentially tier 2, tier 3 can even double up in their realizations. Overall, if we see our average ticket size is around, say, 18,000 rupees per campaign per annum, and 1,500 rupees a month is highly, highly affordable for the kind of services that we offer. So not only in tier 2, tier 3, I think tier 1 cities too can see their realizations improve in coming quarters or years.
Well, Abhishek, what's the contribution of B2B? And I ask you this because recently there was a UBS note where they say B2B revenue contribution can go up to around 38 to around 40% over the next 5 years. As you continue, that segment could grow faster than the core business. Tell us about contribution from the B2B, and can it get to those levels of 38 to 40%?
So B2B contribution was about 25-26% for the quarter in terms of top line. The good part is right now we are seeing strong growth / recovery in both the B2C and B2B side of businesses. B2B definitely holds great potential. It can go to 30% plus contribution in next couple of years itself. But the good part is that B2C also is seeing a great recovery, which is 3/4 of our business at this point of time.
So the operating leverage is leading to margin expansion. To what level do you think you can push the margins higher?
So pre-COVID, we used to be above 25% plus EBITDA margins, 27, 28%. So this quarter, we were at about 14.9%. But with top line growing further and recent cost control measures that we have taken, we expect these margins to continue seeing sequential uptick. And we hope to take them to somewhere closer to pre-COVID levels by the end of the year.
That's interesting. So for about 15% compared to 25% pre-COVID, but you're planning to grow this. Now, cash at 4,000 crores plus. We ask you this every quarter, but we have to keep at it. The pile keeps on increasing. Any tangible plans that perhaps are in the works as a way to use this cash?
So we have about 4,160 crore cash on our books. There are no specific plans at this point of time. Part of the cash, as we have maintained in the past, could get used for any organic or inorganic opportunities, but no specific plans there. It's a good problem to have in my view, and in coming quarters, we will see what is the best way to be able to utilize this cash on books.
Okay, all the best. Thanks a lot for joining in. That's Just Dial. Good numbers coming through, but the stock is under a bit of pressure. But now let's shift focus to the commodity markets. Manisha Gupta is back from her holiday, and she's going to tell us about the one commodity that she's tracking this morning. Manisha, welcome back. And what are you looking at?
Thank you so much for that, Sonia. It's good to be back to work. And I'm looking at metals as a sector because we have seen some profit taking come in for this one after a very strong previous week that we have seen. It's all the reaction to the Chinese economic data that came in today. If you look at the GDP numbers for the second quarter, the number has been at 6.3%. Street was anticipating 7.3%. And that is one of the major reasons you have seen a sharp decline. Apart from that, when you look at the China retail sales number, industrial production, those numbers also came in on the weaker side. If you look at the retail sales, that came in at 3.1%. Market was expecting 3.2%. Also, the China youth unemployment has been at a record high. That continues to weigh on. The other couple of economic data actually came in positive. The industrial production came in at 4.4%. Street was anticipating 2.4%. And then the fixed asset assessment for the first half of 2023 came in at 3.8% versus 3.5% of an expectation. From China as well, it has been about support for exports. We've seen liquidity injections coming in. There has been support extended for the EV buying by the retail street as well. But then apart from that, the markets are anticipating big bang measures, stimulus that hasn't come in from China yet. And as it continues to delay, we are looking at that pressure continue to build up on any uptick that you see in case of the metal prices there. More important would be the Politburo meeting in the end of this month, where some economic policy statements could be laid out. And that's exactly what the street will keep an eye on. Well, apart from that, it also has been about the dollar index, which was trading at a 15-month lows in the previous week. There is a rebound on that. That's weighing onto the street as well. Inflation has eased and that has been supportive. That hasn't been able to hold on for too long, though. And now the markets will watch out for 26th of July. That is when you have the next Fed meeting coming in as well. I just want to quickly take you through the prices on where it has been in the previous week. We did see copper prices trade at around 3-week highs. Aluminum prices closed the week the highest in last 3 months as well. And when you look at how the markets have been in the previous week there, well, we have seen the best of returns come in for gold, silver, platinum. These metals gained anywhere between 4 to 8% in the previous week. In the other industrial metals, though, it has been good gains anywhere between 4 to 6% coming in for aluminum, tin, zinc and copper. This week, though, has started on a weaker note.
All right, Manisha, thanks very much for that. So China growth numbers, a bit of a dampener coming through for commodities especially. We'll take a quick commercial break here. On the other side, our special segment, it's the economy. My colleague Lata will get chatting with Samir Goyal of Deutsche Bank and B. Prasanna of ICICI Bank about the recent fall in the dollar that we've seen. Stay with us.